for conversations like that and others as well. That's at 5 p.m. Eastern Time on Bloomberg TV. In the meantime, though, stay tuned to Bloomberg Radio because Bloomberg Business Week starts right now.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody, live from the Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. It's a drama-free Thursday, January 4th, 2024.
Just you wait.
Just you wait,
The day
Mr.
is not
Stenivek.
over. Plenty of drama. We'll make some drama.
And the year's just getting started. Having said that, hey, Jay Powell, nothing urgent for you here.
Yeah, a batch of data points on the U.S. labor market show companies hiring and wage gains cooling. And so the Fed doesn't have to do anything when it comes to rates?
Yeah, anytime soon. I'll take soft landings for $1,000, Alex.
You know what I'll say?
I still miss Alex Trebek, by the way.
Who doesn't?
I know.
I'll say
What?
it's all eyes on tomorrow.
Yeah, monthly jobs report.
That's what's important.
Yeah, it's an important data point, but so far the jobs data here in the United States seems like, okay, people are still working and people are still getting paid. That means they can still continue spending. We've got some great...
Or they can buy now and pay later.
Well, and we're going to talk about that in just a moment because, yeah, that report on holiday sales is kind of a mixed bag. But having said that, we do have a Fed and Economic Roundtable coming up on what you need to know ahead of tomorrow's monthly read on jobs. And then check it out, the stock market's health, likely stronger than it first appears despite the weak start. That from our Gina Martin-Adams. I cannot wait to talk with her. She'll be with us in just a moment.
On that, we also talk with the one stock optimist who nailed 2023.
Nailed it.
He really did. We're talking about Ryan Dietrich of the Carson Group. He's going to be here. Look, 2023, that was amazing.
Yeah.
But I'm interested in 2024.
Second half was amazing. Late October was amazing. That start. It was a little rough earlier.
Run up until July.
Yeah, that's true. And then we saw some selling.
Yeah.
Yeah. All right. That's a good point. See, this is why we keep Tim around.
Yeah. Sometimes I say
Drama-free
stuff
Tim.
that makes
That's
sense.
Tim.
Yeah, totally.
Peloton. There's a lot of drama around this name in this company, but it's rallying big time today. Might TikTok actually be the answer?
Well, not rallying. Apple, which now has 5 sells, as another analyst this week downgrades the stock, Carol.
I know everybody's beating up on Apple big time. So we're going to look at the fundamental story, the world's most valuable stock, good or bad. We're going to break it down. Apple, based in Cupertino, just outside San Francisco. You know, the tech mecca that we've all been writing off. Maybe we should slow our roll on this one.
Yeah, it turns out the demise of San Francisco is not quite what you've been hearing. Also not happening fast, the ramp up in EVs. We're going to get into why there won't be an EV in every garage this year.
Not in my garage.
Do you have a garage?
No.
Okay.
I have a back parking spot.
So
I'm
maybe
a city
that's
girl.
why.
And here's
If you have a garage, I got some stuff for you to store.
Oh, no. I can throw it in the basement, though. Sorry, millionaires. One more story. You just don't cut it. Only billionaires can afford to buy a home here. This story among our most read on the Bloomberg today, so we're looking forward to that. Having said that, markets and beyond the bell. Countdown to the close right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Scarlett Fu. We're joined right now by our colleagues Carol Massar and Tim Stenivek in the radio booth as we welcome our audiences across all of our Bloomberg platforms, TV, radio, Bloomberg Originals, and our partnership here with YouTube on, I guess, Jobs Eve, Carol Massar.
Yeah.
I guess maybe everyone's just waiting. Market's not really doing much today, which I probably welcome relief given just how poorly it did the previous 2 days.
Well,
but I think a lot can change at 8:30 a.m. tomorrow morning.
I think with the data points, certainly on the labor market so far, showing that there's nothing urgent that the Fed has to do right now. Having said that...
I mean, we're still all employed.
For now. The badge still works.
We all said that at the same time.
One of the things that we've been looking for, right, because we look for other statistics and data points to help us tell what's going on in the economy, and we've talked about the holiday shopping season, especially when it comes to online. We saw it bump up from the year before. It was a record number, this from Adobe. But what's interesting is that a lot of people were doing it with the buy now, pay later programs. In fact, that hitting an all-time record number for those that track it. So it makes me say, okay, great, we're spending, but hey, at some point, like, you got to pay for all this stuff, and you do wonder whether that's going to cause some problems down the road.
Yeah, I have a lot of questions about this data. And that number, by the way, an all-time high of $16.6 billion for e-commerce purchases just in the last 2 months of the year, Scarlett. Are people using buy now, pay later more now, because of the availability of the service, more and more companies are using it. Like, you know, Affirm signed that big partnership with Walmart recently, so it's available in more places. Are they using it because they know about it more? Are they using it in place of credit cards? And at the end of the day, is it necessarily a good thing if people don't have the cash to pay for this stuff now and they're paying for it over a long period of time?
That is the eternal question.
I don't think so.
Right. I mean, for the younger generation, certainly it is replacing credit cards, but it'll be interesting to hear from the banks when they start reporting what they say about credit quality
You guys are
and
such Debbie
card
Downers
use.
here. Well,
I'm
why
sorry.
should no? In all seriousness, why should I be concerned about this? Because I'm not trying to be a flip here, right? But if we're talking about people using basically a form of credit to make their purchases here, is that the fact that it's under these buy now, pay later services, is that materially different than if they had just put it on a traditional credit card?
It is, because these buy now, pay later services, to my understanding, don't have the same credit checks of the people who are using the services. So you don't have to go through the same creditworthiness process.
Although they would argue that, you know,
that's a
that when you
biased
balance it all
process, and
out,
it's not
that's,
necessarily,
and that's a whole nother conversation.
There's a lot of
Exactly.
teenagers using buy now, pay later. Let's just go with
I think
that.
what's also
Are there
interesting.
really?
Well, we've had. Oh, really? Well,
Teenagers shouldn't. I mean,
What's going on in the Foo household here?
I don't know if teenagers should have credit cards.
sounds like
They're
there's a little
targeting
reckoning at
younger
home.
buyers, younger shoppers.
Okay.
How about that?
But I will say there was some, we've had some guests on who said, well, people feel confident to do buy now, pay later. They're like, I'm going to have that money. We know I've got to put aside. I'm just going to do it, take advantage of this, and then pay later. So I don't know.
The U.S. consumer is eternally confident and optimistic.
Yes, yes.
All right, let's talk about how Microsoft is moving forward with integrating AI into its hardware. It's adding an AI key and making a change to its PC keyboard. This is the first change since 1994. Right to the right side of the spacebar on a Windows keyboard, you're going to have the Copilot button. Not right now, Romain.
Oh.
It's going to come out
Focus.
soon. Yeah.
It's where the blue one is,
I don't know
Romain,
how
on
this
your
technology
keyboard.
works. I thought it just showed up.
No.
They
They
just
got to change the hardware and everything. It's going to be a big to-do at the CES show.
Does it
in
actually
Vegas.
do something, the button, when you turn it on?
Yeah, you'll press
know
it,
what
and
it
it'll
does,
launch
Carol
all those
Massey?
What does
AI
it do?
functions.
What does it do? I don't know. You know, it's interesting. We talked with, man, we're a rough crowd today. We're ready for Friday. We talked with Bloomberg senior editor Sam Potter about a recent Bloomberg Big Take. It was basically everything you need to know about Wall Street. They took a look at more than 650 Wall Street calls, and what they found in terms of something that could move stocks this year. So much research talked about artificial intelligence again. I don't know whether that's is it a contrarian call when everybody's talking about it?
Are they late to the party?
Are they late to the party, or it's just a reminder that we're early in on this cycle and there's a lot yet to maybe be gained and figure out?
What's the adoption going to be, though? I mean, I know we're talking about the keyboard, which is definitely much more consumer-facing, where while a lot of the big activity is going on with the businesses behind the scenes, but I mean, has that hype cycle died down?
I think it's just slowly being incorporated. They've talked a lot about it, and then over time they'll start to do it. The second half of this year is supposed to be the time when.
Now, am I
we will
required to
see
now
it.
go out and replace all my keyboards?
No, you don't
gonna
have
be
to.
expensive.
It'll
don't
be
have to
done
do
for
it.
you, Romain.
Yeah,
Oh,
by
really?
AI.
Hey,
It is a
just-
reminder of
They're
Microsoft's
just gonna
commitment
come
to
into my
AI,
house
though. I mean,
when I'm sleeping.
I just hope it's not going to be like Clippy, where you press the button by accident and
The original
that,
AI.
Right. That
Yes.
little clip during Microsoft Excel pops up and you can't do anything else.
Just
I
don't
guarantee
buy
you it
now,
will be.
pay later. Don't do it on buy now, pay later if you're going to do it. All right, guys. We'll
Buy
be
now,
back.
pay now is what I say.
Buy now. Very nice. Sound like my dad. Just saying. Okay, it got quiet all of a sudden. All right, guys. We'll be back in less than an hour's time. Our cross-platform coverage, we're going to wrap up the Thursday trading day. Radio, TV, YouTube, Bloomberg Originals. Join us for Beyond the Bell at 4 p.m. Wall Street time. Bloomberg Intelligence Equity Strategies checklist of 16 key indicators, which continues to improve for a fifth straight quarter. This from Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams, who is here in our Bloomberg Interactive Broker studio. So nice to have you here. Happy New Year. Can't believe it's a new year. Wait, can I ask you something? You were here listening to this conversation. What do you make of the buy now, pay later? Is there something within the equity universe? I don't know.
Oh, I think people are less and less cash rich, and Americans love their credit. So if you're going to give them an opportunity for a free lunch, even if they have to pay for that lunch in a month, they're going to take that opportunity, in particular in periods of time when they're a little bit short cash. And that does appear to be where we are today. I mean, they still have very little debt, which is great longer term, but they are taking on more debt on account of the fact that it's getting more expensive to live. and their incomes haven't really caught up with inflation, even though that seems to be improving in the near term. We've been 18 months in which inflation has been accelerating very quickly relative to income.
Yeah.
And so certain income classes are struggling a little bit more than others. And anytime you give somebody something for free, they generally tend to fall for it.
Do this.
So Gina, how do you square everything you just said right now with the optimism that you and the team have for stocks for this year?
Well, so the consumer is not the market is not the consumer is the first thing to consider. There are potential weaknesses in the outlook, and many of them are consumer-centric. But when we look at the composition of our broad equity markets in the U.S., it's a lot less about the American consumer than I think is popularly believed, and what we've experienced.
But we always talk about the consumer, the backbone of the U.S. economy.
Yeah, more than 60% of
Help me here.
Exactly,
here is by the
yeah. I think that's a really good point, and something we talk a lot about. It's 65% of the U.S. economy, but 30% of the market cap of the S&P 500 at best is consumer sensitive. Also, what you tend to see in a normal recessionary sequence is the consumer slows down their spending, business investment crashes as a result of that consumer slowdown, and the business investment is what really creates the cycle. Business investment's already crashed. ISMs are already sitting at near all-time low levels. LEIs have already crashed. We've already experienced our major deceleration. So it's very difficult to get to a sort of mental construct that would suggest that we're not already at or near some kind of low in the economy. Maybe we have a tiny dip lower if the consumer finally capitulates, but businesses have already adjusted. And we see that in the profit cycle as well.
Yeah.
Within the S&P 500 profit cycle, we saw profits capitulate materially in 2022. We went through a massive recession in profits. Profits are starting to claw their way out of that recession now. So I think what's most important to driving stocks, frankly, is earnings. Earnings are not one-to-one with the economy by any stretch of the imagination, and they're certainly not one-to-one with consumption.
I am printing up the T-shirts. Consumer is not the market. Market is not the consumer. Because I think about how much.
I'll buy that shirt.
Yeah, exactly. I'm gonna get it done.
The other thing I'd like to just add into this, because I'm talking about this for a note on Monday, we're so growth obsessed. In the U.S., it's all about growth, it's all about growth, it's all about growth. But the reality of this cycle, especially over the last 3 years, that we've learned, or we should have learned, is that we should be a lot more inflation obsessed. And inflation doesn't always trail growth. And I think many of us in this market are conditioned on the idea that, well, if growth goes higher, inflation goes higher. If growth goes lower, inflation goes lower. And there's this symbiotic relationship. That's not actually how it always happens. And we learned that the hard way in 2021 and 2022, where inflation and growth really decoupled.
Right.
So I actually think if there's a big risk to stocks next year, it's inflation that remains stickier than anybody anticipated. Even if growth decelerates, that's already expected.
Right.
The whole world is expecting inflation and growth to decelerate.
But we're not expecting
We're
inflation
not
to
expecting
accelerate.
inflation to accelerate.
I agree. And as you think about the Fed minutes from yesterday, where they kind of covered everything. We could cut rates, but we could also raise rates. And I do feel like that's the one thing that's being kind of underpriced in the markets.
Yeah, and I think that that's just a natural byproduct of the fact that we're all human. We work on recent experience. For the vast majority of the last 25 years, we have really just been able to forecast growth and therefore forecast what was going to happen in markets. Something changed. It broke. And it definitely broke in a hard way in 2022. Forecasting growth was not going to get you to where you needed to be with an investment strategy. So we have to consider inflation and what's going to happen with inflation in all aspects, but I think we're really reticent to do so because we're conditioned to only
But it doesn't
really
mean the
focus
end
on
of
growth.
everything, right?
No, it doesn't necessarily mean the end of everything. It doesn't necessarily mean that things are broken. It's just different.
Yeah.
It's just very different than where we've been for most of the last 2 decades.
Well, for most of the last few weeks, you and the team at Bloomberg Intelligence have been very busy because I got a lot of notes from you in the last few days.
Thank
which
you.
love it.
We're catching up after the holiday break.
Well, one thing that was really surprising to me, even looking back on 2023 and how we can use this to predict what happens in 2024, is the breadth, especially globally, of stocks. We talk so much about the Magnificent Seven, but you and the team crunched the numbers, and it was a pretty good year globally.
I know, it's kind of surprising because I think, again, the popular rhetoric has been, oh, it's just all about
It's
the
all
Mag
AI.
7,
It's
and
all
it's
data.
okay if you
It's
missed
all-
the rally because you didn't have the Mag 7, but the reality is we track 20 major global equity markets around the world. 19 of 20 posted returns. 60% of global stocks posted returns. 45% of global stocks posted double-digit returns last year. It was one of the greatest years for stocks in the last 25, one of the top 6. So we had a really good year in equities in 2023. Not a great year in small caps. Without a doubt, small caps were really left behind. Emerging markets, especially emerging markets when you include China, were left behind. So there were Not everybody benefited significantly, but a great deal of the equity market did do quite well in 2023.
So how do you measure that? Is it the number hitting their 52-week highs?
Yeah.
What is it that you look at?
Yeah, so we look at a lot of different things. We
Yeah.
just, for that study, we just looked at the absolute returns just to kind of report in on, hey, here's actually what happened. And it looked pretty decent.
Yeah.
I like to look at the percentage of stocks trading above their 50 and 200-day moving average as my favored breadth measure, because I tend to find it gives me some indication as to what to expect for price trend. It also gives some near-term toggles for the equity market. So, for instance, at the end of last year, we got to a point where 75%, more than 75% of stocks were trading above their 200-day moving average, which
That's
is
significant.
It's a very big breadth number, but it's also a bit extreme.
Okay.
And it paired really well with things like our market pulse index, which was saying the market itself sentiment is far too bullish. RSI momentum also got to a very high extreme by the end of the year. So we were set up coming into this year to have a cool-off period. At the very least, we needed to move out of the party that we had in December.
Right. And that's to be
and
expected.
cool off and let the market
much of a
find a
cool-off?
new equilibrium.
How much of a cool-off?
It should be relatively small, just because most of the other conditions that we tend to follow for driving equity markets are pretty supportive. In particular, the earnings trends. Frankly, I think it's kind of gone unnoticed that earnings made a major low in 2023 and are starting to climb out of that low. Most sectors are going to participate in an earnings recovery this year. The 493, so in the non-7 that we talk about, the 493 S&P 500 companies that don't get as much play are actually supposed to produce their first quarter of earnings growth with the fourth quarter earnings season coming up. The first quarter of earnings growth we've seen since 2022. So we should see some earnings momentum gather throughout the year. A lot of it is because inflation is decelerating. It's not because you got a big growth recovery or robust revenue recovery. It really is inflation needs to continue to decelerate to power that
One of the
recovery.
things we were talking about the end of the year, and just got about a minute left here, is that all the money that's sitting in money markets, do you anticipate that comes back into the equity markets this year? Or I don't know, how are you thinking about
I think
that?
you've got to get probably a stronger recovery in small caps and a broader recovery into all stocks. Probably need to get the Fed to ease.
Okay.
Because then that changes the math, right? Right now, the math is not in favor of stocks relative to cash because the PE ratio is so high, with the exception of small caps. The math works very well for small caps, which are trading at incredibly low valuation ratios. So your earnings yield on small caps is pretty strong relative to cash, particularly if we go into an earnings recovery this year. But large caps, it's a harder case to make. So you'd say small caps and emerging markets, those are the two markets to watch. If we get some momentum there at the same time, we get a little bit of Fed ease, those could be the areas of the market that really trigger a broader move into the equity market.
More so,
like everything coming
very
together.
briefly, more so into the equity market than into the bond market from money market funds?
Yeah, no, I think that right now investors are considering all options because you still get a plenty of yield in the bond market as well. But we've had such an extraordinary rally in the long end of the curve. It's probably more in the short end that they consider their options in the bond market. Also, I would be remiss not to note that, cash and equities are not direct substitutes for one another. And so certainly there's an array of opportunities for investors to consider.
The God here. Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. Her research always a must-read. Thank you so much. Happy New Year.
Thank you. You too. Thanks for having me.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow higher, the S&P, NASDAQ, and the NASDAQ 100 index all trading lower right now. The Dow's up 78 points. That is a gain of 0.2%. S&P 500 index lower by 4, drop there of 0.1%. NASDAQ down 44 now, a decline there of 0.3%. The NASDAQ 100 index, by the way, flirting with its longest losing streak since December of 2022. Treasury yields rose while stocks drifted ahead of the jobs report tomorrow morning. 10-year yield 3.99% and the 2-year 4.38%. Spot gold up $2.50 the ounce to $2,044. That was a gain of 0.1%. Bitcoin up 2.7%, 44,106 on Bitcoin, while West Texas Intermediate crude is down 0.5%, 72.32 a barrel. The Labor Department says jobless claims are down, the lowest since October. Investors are digesting the claims data ahead of the jobs report tomorrow morning with an eye toward the number of rate cuts this year. Amanda Lynham is Managing Director at BlackRock Financial Management.
I think as it relates to the data for the rest of the week, specifically non-farm payrolls tomorrow, I think really what the data this morning is highlighting is that there are upside risks still to the economy. And so the market is probably right in calibrating expectations for significant swift rate cuts in the early part of 2024. And I think that that's appropriate.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcast. And, of course, a whole lot more on the jobs report coming up with our Michael McKee in just a moment. McDonald's says it is experiencing a, quote, meaningful business impact in the Mideast due to the war between Israel and Hamas. That's according to CEO Chris Kempczynski. Shares of McDonald's, they're down now by 0.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Tim Stanovic right here on Bloomberg Business Week. Well, we did get 3 more reads on the U.S. labor market today. They showed net U.S. companies ramping up hiring in December, wage gains continuing to cool, consistent with an outlook for sustained economic growth and diminishing inflation. So chalk one up, it seems, for the soft landing camp as we await tomorrow for the big one, the monthly jobs report, Tim, from the U.S. government.
So also of note, the Federal Reserve Bank of St. Louis has a new president, appointing Alberto G. Musalem, whose career includes executive roles at Tudor Investments and the New York Fed, as its new president.
Yeah, so there's a lot of moving parts here. So let's get to it with Bloomberg News International Economics and Policy correspondent Michael McKee here in our Bloomberg Interactive Brokers studio, and then out in our Atlanta bureau, Bloomberg News Economics reporter Steve Matthews. Happy New Year to both of you. Mike, I do want to start with the jobs data, kind of the dump that we got. Jolt yesterday, weekly jobless, ADP today. Add it all up, how is the labor market doing? Anything of note in the employment data so far this week?
Well, it's a dog that hasn't barked.
I like that.
We're basically seeing the same story continue.
Not whimpering either?
That the economy is in good shape and the labor market is in good shape and companies are likely still hiring. We'll find out more tomorrow when we get the Bureau of Labor statistics data, but everything kind of points in the direction of mostly status quo, maybe a little bit slower. The Fed and others wanted a little bit slower because they still tie inflation to unemployment and job growth. So we could go down a lot and the Fed wouldn't be upset. But right now, it doesn't look like that's happening. On the other hand, we're seeing inflation fall, so we're in the best of both worlds.
Steve, when can we just say the plane has landed and it was a soft landing?
Come on, go for it. Say what you want to call this.
The miracle on the Hudson.
Sullenberger. He's got a term he wants to get out there.
I think you can declare that when the Fed gets to its 2% target and the economy is still growing at a reasonable rate. And it's like you're very close to that now. I mean, as people pointed out in the last inflation report, if you look at the 6-month annualized figures for PCE inflation, personal consumption and expenditures inflation, is running slightly under 2% on a core level, core being excluding food and energy. And this is all kind of like a little bit too technical, but when you get to when you get a full year of data and it's at 2%, I think the Fed would be, in good shape to declare victory so long as the economy is still growing. Then you would have officially had a soft landing.
Wait, so does that mean we have to wait for 6 more months, Steve?
You have to wait 6 more months.
Or more?
Absolutely. And that's what you're hearing from the Fed. I mean, I was just in Raleigh speaking with the head of the Richmond Fed, Tom Barkin, and he was saying, yeah, it's too early. This is the same thing you were hearing from folks in December with the Fed, that, yeah, it's much too early. We need some more time. And that's why there's been some pushing back against the whole idea that the Fed's going to cut rates in March, which, I guess it's a plausible scenario, but right now the Fed is very much pushing back against that and saying we need more time, we need more evidence that this is sustainable, and they're not ready to declare that yet.
So, Mike, in terms of what market indications or traders have been expecting, these 6 moves or 150 basis points worth of moves this year versus what the dot plot showed, which was about half of that, right? About 3 moves. So how are you, I don't know, thinking about that? Is it just an idea that there's going to be quite a range and we're just going to have to see what the data shows us?
Well, when you look at the dot plot, you see an enormous range for this year, much more so than you normally see in a dot plot for the current year, where the out years are always quite spread because nobody knows what's going to happen. But this year, there's still there's a range from no move at all to 6. Now, those are outliers, one of each, but the spread there on the dot plot for 2024 tells you the Fed officials are uncertain as well. They're trying to figure out for themselves how many times they could lower rates or might have to lower rates depending on their economic outlook, and they don't really know. They're taking things one day at a time, and I hate to fall back on the old data-dependent cliche.
It's okay.
But
you're among friends.
We're sort of data-dependent here. The Fed's going to want to see evidence, and Steve makes a good point about the 6 months, whether it's 6 or 5 or 4 or whatever. They're going to want to see a number of months of continued progress on inflation, and strong enough growth that they're not going to worry about us slipping into recession before they really make a call.
So does Steve an uptick? We just talked about Tina Martin Adams, and she says one of the things she thinks the markets, the equity market, is underestimating is the ability for inflation to tick higher. And we've heard this from some different guests too. So in terms of the Fed, if we get one reading of inflation ticking higher, do we all do a reset on the investment side? And should we?
Yeah, I think that the Fed is expecting that this is going to be bumpy. You've heard this from Powell, that the path toward lower inflation is going to be filled with bumps, and we really haven't had any bumps in the last 5 or 6 months. And there are some reasons to believe. There's some seasonality, and there are revisions to CPI coming up, and Mike knows this stuff better than I do. But there's every reason to believe that there could be some bumps in the next several months. And if that's the case, that's going to take March off the table. If you get some kind of surprise, in that with higher inflation in the next couple of reports, you're going to have to be looking later in the year, assuming that there's no evidence of recession, and there has been none so far.
A week from today, CPI. And we are probably going to see an increase because of base effects. December a year ago, we saw inflation drop, and it was a one-off thing. But then you get this base effect now, where the rise in inflation is going to be higher because of that, and so there's going to be nuances to all of this, and this will be one of the bumps that Jay Powell is talking about. And markets they don't do nuance very well. They're going to have to learn to do that.
Steve, has there been anything in the data over the last 8 or 10 weeks that has been to you a sign that things aren't moving in the direction of a soft landing?
There has been very little to suggest that we're not headed toward a soft landing right now. You do hear forecasts, and there are some forecasts out there that the recession could have even begun by now. Our own Anna Wong has made a good case that maybe a downturn began in the fourth quarter, but in the data that we have gotten so far, there are occasional signs of softness, But it's like you look at the jobs data today with the unemployment claims, and everything seems consistent so far with a soft landing. There may be just some slight softening of consumer spending, but not really much.
Yeah. Hey, listen, we just have about 30 seconds. Mike, this new president of the St. Louis Fed, what do we need to know?
Well, he didn't take over till April 2nd, so he's going to miss the first two Fed meetings of the year. We don't know a lot about his views on monetary policy. However, I would point out that he has worked on Wall Street quite a bit and knows basically what the markets are looking for and will be a good liaison there. But also much of his career on Wall Street has been spent in the international arena. It's interesting, he's moving now to the central United States, the heart of America, to be a Fed bank president, but he should bring some international expertise to the Fed's policy deliberations.
He may be the most internationally experienced Fed president there is, which is really ironic because he's in the middle of the Midwest.
Yeah. We don't know if he's a baseball fan. Jim Bullard was a huge Cardinals fan. We have to find out if Mr. Musalam is a baseball fan.
He will have to become one soon if he's not now.
It'll be really good, though, considering that, you know, when we talk about monetary policy, we think about it as a global level and what's going on. Guys, you rock. Michael McKee, of course, Bloomberg News International Economics and Policy Correspondent, and, of course, our Bloomberg News Economics reporter, Steve Matthews.
Hey, let's go to Washington, D.C. now for checking the latest world and national news. Nancy Lyons is in the 99.1 newsroom. Hey, Nance.
Thanks, Tim. President Biden is monitoring today's shooting at Perry High School in Iowa. Multiple people were shot by a gunman who entered the school before the morning bell. The gunman apparently shot himself. White House Press Secretary Karine Jean-Pierre says students and teachers need to be protected.
Congress must enact universal background checks, ban assault weapons and high-capacity magazines, require safe storage of firearms, end the gun industry's immunity from liability, and pass a national red flag law.
Jean-Pierre says families keep asking, when is enough to take action? 17 bus companies that have transported more than 34,000 migrants to New York City over the past 20 months now face a lawsuit. Mayor Eric Adams is seeking money from the companies to cover the cost of caring for the migrants.
These companies have violated state law by not paying the cost of caring for these migrants. And that's why we're suing to recoup approximately $700 million already spent to care for migrants bused here in the last 2 years by the state of Texas.
Adams says Texas Governor Greg Abbott continues to use human beings as political pawns and says it's about time for the companies to take responsibility for their role in the crisis. Actress Glynis Johns has died. She'll be best remembered for her role in Mary Poppins.
Our daughters will adore us, and they'll sing in grateful chorus. Well done, sister suffragettes.
Glynis Johns was 100 years old. She's also the original voice for the memorable Stephen Sondheim song, Send in the Clowns. She played the role on Broadway, but lost it to Elizabeth Taylor for the film version. Global news 24 hours a day. I'm Nancy Lyons.
stocks, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at a decidedly mixed Thursday. The Dow higher, S&P, NASDAQ, both in the red. NASDAQ 100 flirting with a 5-day losing streak. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks mixed in a choppy session. The Dow is currently higher by 96 points. The S&Ps are down by 2, and NASDAQ is lower by 39. The U.S. 10-year yield at 3.99%. Gold is up 2. Oil trading in the red, but Bitcoin is higher by 2.5%. Among the main 11 S&P sectors, leaders were healthcare and the industrials. Energy was under pressure, and leaders to the upside, the Dow, Merck, and Amgen, while Walgreens plunged as much as 12% after cutting its dividend by 48%. In deal news, APA is buying Callon Petroleum for $4.5 billion. And wrapping things up, Mobileye plunged as much as 29% as full-year revenue forecast missed estimates. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type SQUAK, SQUA, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody. We've got just about 18 minutes left in today's trading session. And the markets, you just heard Charlie breaking it down. A little bit of a mixed trade. Higher on the Dow, a little bit lower, though, on the S&P and NASDAQ. It does feel like we're kind of limping into 2024, but we've got a big jobs report. Having said that, late last year, you probably read this on the Bloomberg. Bloomberg News highlighted the stock optimists who nailed 2023. Among them, Tim, was Ryan Dietrich.
He's chief market strategist at the Carson Group. He expected the U.S. economy to avoid a recession. Last year, Carol, he also bet inflation would cool sooner than the market was expecting. Ryan even added exposure to stocks during the banking turmoil in March and as the S&P 500 sank in October. Looking like a pretty good series of calls.
Congratulations, Ryan, because you were highlighted in our story. Happy New Year. How confident are you making a call for this year?
Well, Happy New Year, guys. Thanks for having me back. I mean, we're still pretty confident, right? We still, will we gain 24.2% on the S&P this year? History would say probably not. But we think low double-digit returns makes a lot of sense. And again, we can get into all the details, but we just still see a strong consumer, likely with housing coming back, with manufacturing showing signs of bottoming, that the odds of a recession, in our opinion, are still quite slim. And when you can avoid a recession, stocks tend to do well. And here's one more. I mean, I know the S&P hasn't made a new high for like exactly 2 years, right? 2 years ago yesterday.
Right.
And we think we're going to hit one eventually here. We're not that far away.
Well, we talked about this
too. 14 times.
Well,
what's that? Go ahead.
No, but I was going to say, in the last 2 years, the S&P, if you really look at it, has really gone nowhere. But forgive me, I interrupted you, and you had a smart thought. Go ahead.
Oh, no, I don't know how smart it was. We'll see. You let me know. But yeah, for 2 years, we've gone nowhere. But here's the thing. Since 1950, Carol, I found 14 times the S&P went at least a year without a new high. So a long time without a new high. We're in that scenario now. After it makes a new high eventually, and it will this time, we're pretty sure. We're pretty certain. 1 year later, S&P's up 13 out of 14 times, up like 15% on average. So I hear so many people saying, listen, we were up a lot last year. We moved a lot. That is true. But zoom out, literally stocks have almost gone nowhere for 2 years. And that might be a reason to be bullish for investors.
What about when it comes to the technicals at the start of the year? Because I know, Ryan, you have, I follow you on, I was going to say Twitter. I follow you on X, where you're always tweeting about these technicals. The S&P 500 down for a third day in a row. It has had, we don't know how it's going to close, but it might close in the red. If it does, it will not have closed in the green once this year. It's only been 3 days, but does that portend anything for the rest of the year?
Yeah, we would say no. I mean, it's awfully early. Let's remember here, the S&P's up, as you guys talk about, 9 weeks in a row, right? You look at the future returns after 9-week win streaks. It's pretty solid, 6 and 12 months later, above average. Now, listen, I'm aware, right? We just had the Santa Claus rally period, the last 5 trading days of a year, and then the first 2 of a new year. And we were negative, right? And that's pretty darn rare. And you go back the last 30 years, when we didn't have Santa Claus come to town during those normal 7 bullish days. January's been red a good amount of time. First quarter's been flat. So maybe we're due for a well-deserved break here, but we need to see more worrisome signs, Tim. Specifically, where's the leadership coming from? Like, are utilities leading? Is healthcare leading? Staples leading? Some of the more defensive areas, we're not seeing that yet. So the message of the market to us is we're probably just maybe due for a well-deserved break. And we still think that, one more for you, it's the first quarter of an election year.
Yeah.
Historically, you look at all 16 quarters of a 4-year presidential cycle. This is one of the weakest quarters. So just kind of be aware, and last year was obviously a good year, right? So be aware, maybe we're in that time frame where we could catch our breath, perfectly normal. We don't see any major warning signs cropping up just yet.
Do you want defensives to rally, or would that be a sign that things are coming undone a little bit?
Yeah, no, that would be a great question, Carol. I mean, that'd be a sign things are probably coming undone. We don't want to see that type of leadership. I mean, you look back in 2021, right? Or late 2021, defensive started to lead. And we all know 2022, all the spiral that happened. So there was some warning signs in late 2021 that maybe something's off. We're not seeing that, though. I want to be very clear. So we're encouraged by that.
What are some things that could change your tune? You say you still see a strong consumer. The odds of a recession are slim. What would make you say the odds of recession are no longer slim and they're looking more likely?
Yeah, I mean, we love to follow the credit spreads and credit markets. I know I come on to you guys a lot last year. I think we talked about these things. What are the triple B spreads, investment grade corporate spreads? Keep it fairly simple. If there's a monster under the bed, we think the credit markets would show it. Back in March when we had the regional bank crisis, and obviously a lot of worry, we didn't see credit spreads blowing out. So we saw that was an opportunity. We saw the same thing in October. So that to me is one that we're going to watch. And then on our team, I know, hopefully I can say the F word on the radio, the Fed, the Fed.
You made our producers in the control room a little nervous there,
Did
Ryan.
I just freak them out? Sorry.
Paul Brennan is like,
It's my joke.
Paul
Sorry,
pulled
Paul.
out all
It's
his
my
hair.
joke.
Yeah. Oh my God, he did.
No. The Fed. Could there be a potential policy mistake? We think the Fed should start cutting pretty soon, right? We were on that record, like you guys talked about when I first came on, that they could, but now maybe they can stay a little hawkish, and maybe that could upset the apple cart. We don't expect that to happen in the market. Boy, the market's voting, right? I mean, 6 cuts, it might be a little high, but I mean that's something that could be out there as well. But here's one more for you. When you have a good end of year rally, like we just did, up 14% for the S&P the last 2 months of the year, when you gained at least 10% those last 2 months, only happened 6 times. The full next year has been higher. 6 times, up 20% on average. So I call that like a slingshot, right? I mean, when you have a lot of strength to end a year, history would say, listen, price side with that following year still being pretty strong.
It's a shame you don't have any kind of bull feelings out there, Ryan.
Wait, hold on.
I want to ask you about Apple, because you and I talked about this
quickly,
off
so
air.
then I can get my question in.
Apple's below its 90-day moving average. Is that problematic? Quickly, because Tim has a question.
I mean, for tech, potentially. I mean, Apple, we all know, is very large. One of our big themes, we've been talking about it for a while, is that rotation from large caps to small caps and mid caps and technology to industrials. We're seeing that. So, sure, if you're overweight tech, that's a potential concern. But, I mean, there's a lot of other groups that I think are going to take that baton, Carol, and that's just the next phase of this bull market as we move forward, in our opinion.
Okay, Ryan, have you been at all bearish in the last few years? Be honest.
Yeah, we were neutral equities, the majority of, 2022, right? And we moved overweight equities late of October of 2022, or November of 2022, actually. So were we outright bearish? No, we were not. But we were even weight, and we had overweight fixed income as well. We've been underweight fixed income, overweight overweight equities really since the end of last year. So, we'll see, but it makes sense. I mean, listen, 71% of the time the stock market's up, 9% on average. We get all those things, but we've definitely thought there's some opportunity here, and we still think that's the case, Tim.
Small caps, mid caps, financials, those are still your 3 favorites. That's what you told our print team. Just 20 seconds here, real quick.
That is exactly right. I maybe throw industrials in there as well. Those cyclical areas, if you don't have a recession, this rotation from tech and large cap to the smaller names, the cyclical names, that's how we're positioning the models that we run for our Carson partners.
All right. Well, great to check in with you on this these first few days of 2020. For Ryan Dietrich, he's Chief Market Strategist at the Carson Group, joining us on this Thursday. You are listening and watching, so you got your question in.
I did.
This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. McDonald's says it is experiencing a meaningful business impact in the Middle East due to the war between Israel and Hamas. That, according to CEO Chris Kempczynski. Shares of the burger chain are trading lower now by just about 0.9%. Mobileye global shares down 25% after the Israeli autonomous driving technology maker gave a full-year revenue forecast that fell far below Wall Street's expectations. And with more, here's Bloomberg's Ed Ludlow.
Mobileye makes chips or systems on a chip that power the sensor suites for advanced driver assistance in cars. And what they're saying is that after the chip crunch of 2020, all of those tier one suppliers that were worried about chip shortages for ADAS bought up inventory. Those inventories are too big, and so now they've stopped buying, and they need to work through the inventories, which Mobileye says will happen in the first quarter of this year.
Bloomberg's Ed Ludlow. Mobileye is Israel's most valuable publicly traded company. It also anticipates first quarter revenue will be down about 50% from a year earlier. Mobileye right now down 25.3%. Peloton Interactive shares up 14%. It has launched a partnership with TikTok to create a fitness hub on the popular video app and tap into a new pool of potential customers. The agreement marks the first time that Peloton will produce custom social content for a partner outside of its own network. And those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
All right, everybody, just about 4.5 minutes left in today's trading session. So we're going to head over to our TV colleagues in just a moment, and we'll talk a little bit about the trade today. We're really kind of waiting for that Friday jobs report tomorrow at 8:30 a.m. Wall Street time. Having said that, a story that's on our radar has to do with Eli Lilly, launching a service to sell its weight loss drugs directly to the public. What is that, B2C? Pitting the company against startups such as Ro and Noom that have fed the frenzy over GLP-1 medications by making them easy to access online.
This is a really big deal.
I
Because if
agree.
you think about the way that you get drugs now,
I go to the drugstore, the pharmacy.
after you go to the doctor to get it, right?
Correct.
And you can use these pharmaceutical startups as well.
How do you get your medications? Do you get most of it?
I use a delivery service.
You do?
Yeah, it's. Look. This stuff is different in New York than it is everywhere else in the country. I always have to remember when you talk about this stuff.
Right.
But the local drugstores were just getting so crowded, and they were so overwhelmed, and so often they didn't have medications, and it was just so confusing that I just download this app and
Yeah, no, I
it's
see.
so much easier.
But you do wonder, apparently it's called Lilly Direct. It's
Yeah.
going to help connect patients with obesity, diabetes, and migraines to doctors who can prescribe the medications, including some of the ones that are out there already. They put this out in a statement today. It's also going to offer direct home delivery of certain drugs through third-party pharmacies. Lilly has partnered with closely held Form Health. It's a virtual weight loss program on obesity and will work with 9am Health on its diabetes offerings, which to me then makes me think about WW, right, who as part of its weight loss program, that access to these drugs as well. That was
Have
a
you
big part of it.
seen? Have you seen WW shares today?
No. What are they
Down
doing?
more than 11% as a result
This
of this.
is competition.
It is because WW, also known as Weight Watchers, they've been prescribing drugs made by Lilly and Novo Nordisk, like Wegovy, as demand soars. That's part of the value proposition for Weight Watchers now. So if you get it directly from Eli Lilly rather than going through Weight Watchers, then that's competition.
Yeah, it's really kind of interesting, right? Yeah, absolutely. If they're going to get in on it, you think about their ability to really sell that drug and get it out to patients.
And
So-
to be fair, Weight Watchers more than doubled last year.
Yeah, they did on that.
That acquisition.
All right, guys. Watching that, but also watching the broader market. Leg down here in these final few minutes. We're heading over to our TV colleagues. Talk about the trade beyond the bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Stenivek. Welcome to our audiences across our Bloomberg platforms. And I feel like this is a rinse and repeat, though, of the last couple days, guys, where as we get closer to the bell, we start to see the sell-off intensify here. Stocks right now at session lows.
Yeah, negative tone here, right? In these final few minutes, we're all thinking about tomorrow's monthly jobs report. Having said that, the NASDAQ 100, 5-day, on track for a 5-day losing streak. And that would be, the longest that we've seen since December of 2022. So we think about, kind of technical moves or trend lines. That could be fairly significant.
We just talked to someone who's very bullish, and he has a pretty good track record, at least based on what he made, the call that he made last year. We're talking about Ryan Dietrich over at the Carson Group. He says he still sees a strong consumer. He's still bullish right now. He says the odds of recession are slim. And when you have a good end of the year rally like we just had, it's like a slingshot for the next year. And he says on average, stocks go up double digits after a rally like we saw in the last 2 months of the year.
Yeah, but what happens next will depend entirely on earnings and whether the earnings can justify the gains that we've seen so far, particularly in some of the companies that have really led the way, the Magnificent Seven among them. It'll be interesting to see whether that happens. Katrina Dudley of Franklin Mutual is just telling us she sees them as more likely to underperform than outperform.
Gina Martin Adams talking about earnings hitting a major low in 2023 and maybe set for a recovery. So I guess we'll get to get a feel of it, you guys, as earnings start to come out.
Well, one thing I thought was interesting is, as we do those surveys where they get the year-end strategist estimates, and they also ask them for their year-end estimates for earnings on the S&P in aggregate. It's kind of interesting to see that the pace of upgrades on the price target did not go up as fast when it comes to the actual earnings numbers themselves here. So a bit of a disconnect, maybe, potentially. With the mixed bag here on Wall Street, with the Dow Jones Industrial Average, once again, holding in the green, but only by a fraction of a percent, up about 10 points on the day. The S&P 500 decidedly in the red, down 16 points or 0.3%. The NASDAQ Composite lower by about 0.6%. And the Russell 2000, which had been fighting to stay in the green, is going to close it out in the red, only down by about 1.5 points.
Yeah, I'm thinking about a headline. What was it about an hour ago where money markets, fund assets rising to fresh records from the ICI. So I'm thinking about investors maybe just taking some money off the table, Scarlett, after the runs that we saw last year.
Yeah, although it's notable that that rotation out of tech and into things like small caps continues, with small caps outperforming the broader market and certainly outperforming tech. All right, this is what the S&P 500 looks like when you split it up into 24 industry groups. Healthcare equipment, banks, and household and personal products leading the gains, although these gains are fairly modest, no more than 2/3%. On the downside, falling oil prices dragging all 23 big cap oil companies lower. Retailers also down by 1.6%, and tech hardware lower by more than 1%.
All right, let's get to some of the individual gainers. I'm sure you guys were talking about it. Peloton up 14% in today's session, launching a partnership with TikTok to create a fitness hub on TikTok and basically tap into a whole new, bunch of customers potentially and users. So this is what they're looking to basically broaden their audience. The agreement marks the first time Peloton will produce custom social content for a partner outside of its own network. It's had its own kind of network and keeping it within the house. So now it's reaching out. Stock, keep in mind, still down about 95% from its all-time high back in January of 2021. So it's got a lot of ground to catch up. Cannabis stocks, I don't know if you guys noticed, on a little bit of a move higher, if you will.
A little bit of a what?
Curaleaf Holdings, I'm ignoring, up 3.8% in today's session, up almost 7% at its highs today. The Drug Enforcement Administration here in the United States confirmed it is reviewing marijuana's federal drug classification. So could this give some juice, if you will, to some of the cannabis companies that are out there? We shall see, but it definitely in today's trade, in what was overall a lower trade. Dollar General, number 2 gainer in the S&P 500. Barclays upgrading it to overweight from equal weight. They shifted from a defensive view to a more balanced view on broad lines, hard lines, and food retail in 2024. Home Depot, by the way, also getting an upgrade from those folks. So we saw Dollar General up 2.6%. And I did want to mention Netflix. It was up about 2.25% at its highs today, still finishing with almost a 1% gain. JP Morgan bullish on the company, talking about its ability to accelerate revenue growth, expand margins, and drive multi-year free cash flow growth. And they also talked about the company maybe expanding some of their price increases to some other markets. They've already started doing that, we know, in the last year or so. So, yeah, some gainers here.
Okay, well, let's go to decliners. This one, the same first decliner that I've said for the last 2 days. Checking in on shares of Apple, down more than 1.2%, down for a 4th day in a row today. This after analysts at Piper Sandler cut their rating, citing a weak macro environment in China that will dampen demand for iPhones. Apple down 6% in the last 4 days. It's shed $180 billion in market cap just over the last 4 days. Got to talk Mobileye, too. They were down as much as 29%, having their worst day ever earlier in the day, still closing down 25%, having its worst day ever. This is the autonomous driving technology company that provides the tech for companies like Porsche and Volkswagen. Shares falling to their lowest level since November of 2022. That was just a month after the company was spun off from Intel. The company did give a full-year revenue forecast that fell far below Wall Street's expectations. And the company did say that customers are paring back orders because they have excess inventory. This is an interesting one. Weight Watchers, WW International, as it's known now, down 11.1% today, plunging the most in more than 3 months after Eli Lilly launched a digital healthcare platform that's going to allow the drug maker to directly deliver these GLP-1 weight loss drugs to customers. That's a threat that threatens a key area of growth for WW. WW has this direct-to-consumer platform that they acquired in March of last year, Romaine, and that helped propel shares to more than double last year. But getting hit today on this Eli Lilly news.
All right, some of the big movers in the equity space. Let's check in on what happened in the bond market today, particularly when it comes to treasuries. And the sell-off in treasuries did continue, a fourth straight day of price declines for the 2-year treasury, which pushed yields higher on the day by about 5 basis points, 4.38 right now on your 2-year. The 10-year did trade above 4% once again today. It looks like settlement's going to come in just a smidge below that here. But once again, the entirety of the yield curve shifting higher here, and that's largely because of a lot of mixed opinions right now about what the Fed may do next. But the consensus, at least for today, is that all of those rate hikes, the 6 rate hikes that have been priced into this market as recently as 3 days ago, maybe, just maybe, that might be a bit too extreme.
Yeah, but that was the case a couple of weeks ago as well. What the Fed does next, of course, will be determined by all the data that's out there. The Fed is data dependent. And of course, we get the big jobs report tomorrow. I don't know what you guys have been hearing from the guests you've been speaking with, but when we talk to people, they're all saying they're looking at wages because wages is a source of concern, and particularly when it comes to earnings, that a lot of these companies can't pass their costs on anymore to the consumer.
Yeah, and you think about how that's going to play into the pressure on those inflation numbers and what happens. We did talk with Steve Matthews. I mean, what they want to see in terms of the core PCE number that the Fed looks at, that key metric, that it has gotten below 2%, but they want to see it for a longer period of time. He talked about, what, another 6 months maybe of it. So it does make me wonder how much the Fed is just going to hold off and make sure that in terms of inflation being put to bed, that they've really done it.
It does remind me of our conversation earlier with Gina Martin-Adams, who reminded us that the consumer, Romaine, is just not as strong as the consumer was over the last 18 months and is starting to get tapped out. But at the same time, she doesn't think that's going to affect stock valuation significantly because she said the consumer is not the stock market and the stock market is not the consumer. So even if consumers don't feel as comfortable as they've been feeling over the last few years when it comes to how much excess cash they have, their spending power and more, that's not going to affect stocks the way that a lot of people think it would.
Yeah, well, it may not affect stocks in aggregate here, but there's certainly pockets of this market, particularly once you get outside the S&P 500, that are a little bit better reflection of the economy. And you see the drag in those stocks over the last, I don't know, 4 or 5 months that maybe gives you a sense here that we've seen that tamp down.
Well, look at ConAgra today, for example.
Yeah. Okay, there you go. Yeah. I thought you told me it wasn't the economy.
It's not the whole economy.
Okay.
Walgreens,
I'm not trying to be flip here, but the stock market isn't the economy, but it does reflect back on the economy, and the economy reflects back on the stock market. And we've seen the weakness there. The question is how widespread is that consumer weakness, I should say, how widespread is that consumer weakness going to be, and do we need to worry about it? The other posit that's been out there is this idea that we could end up in kind of one of those bifurcated recessions where people at the lower end of the spectrum feel the recession. People at the higher end of the income spectrum, they don't feel a thing.
Well, we heard during the last earnings season from companies that were saying that things were not looking so good in the new year and that consumer spending was starting to look a little bit iffy, but that didn't stop the rally from happening anyway.
No, but I go back to what Romaine said. I would argue that, already people at the lower end of the economic spectrum are feeling it, no doubt about it. We have these conversations, inflation, not at levels we saw a year ago, but prices are still higher. Yeah. And so
and I'll just say, and I don't want to editorialize too much, but I mean, we've been down this road before in past business cycles where everyone said, look, everything's fine. Yeah, there's weakness there, but look, the stock market's not the economy, and we know what happens next year. Sentiment can shift on a dime here, and it's not always just about what that headline number and whatever data report says. It's really about the feeling on the ground, and if people aren't spending, that has a way of catching up with us really fast.
Right, or like we talked about earlier, the buy now, pay later. If more people are we've talked about, tapping credit or getting tapped out, if you will. That's already problematic. And
did we resolve the question of whether that was problematic or not? I thought there was some disagreement on that.
There's still disagreement.
There's some red flags going up.
We'll get back to you tomorrow.
Yes, do that, please.
I'm done.
Yeah, tomorrow.
All right, guys. Obviously, tomorrow we'll be talking about the jobs report. That's a wrap for our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it Beyond the Bell. We will catch up with you tomorrow. Little BB King. Yeah, we're a little worried. Feels like the street's a little worried about Apple. Tim, you were just talking about it. One of your decliners, shares of Apple down for a 4th day in a row. moving below its 90-day moving average. This after analysts at Piper Sandler cut their rating today, citing a weak macro environment in China that will dampen demand for iPhones. We heard some worries just earlier in the week.
Yeah, that follows the more bearish move by analysts at Barclays, who cut their rating to underweight on Tuesday. In all, Carol, Apple is down 6% in the last 4 days, shedding $180 billion in market cap. We should note there are now 5 sells on the stock, so that pushes the company's buy equivalent ratio down even further, with the percentage of analysts bullish on the company at a 3-year low.
Yeah, so it's interesting. All right, so what's going on? Is 2024 set to take a big bite out of Apple? We've got a great roundtable. Mark Gurman is Chief Technology Correspondent at Bloomberg News. He joins us on Zoom from our LA bureau. And Anurag Rana is Senior Technology Analyst at Bloomberg Intelligence. He joins us on Zoom from our Chicago bureau. Guys, thank you so much. Happy New Year to both of you. I do want to kick off with you, Mark. You cover this company like Anurag. You talk with them, you check out their products, you do your channel checks. Should we be saying, Cupertino, we have a little bit of a problem here?
You know, I think 2024.
Don't take me back there, please.
Yes, could shake out to be one of the most pivotal years in Apple's history. There's a lot going on. They have a pretty, compelling product roadmap for the year. The Vision Pro headset, their first new category in 9 years, larger iPhone displays, biggest change to the iPad since 2018, big changes to AirPods and the Apple Watch. So there's a lot going on here, but, big but, the iPhone sales concerns are a real problem. The fact that we're likely going into our 5th quarter in a row of revenue decline, that's a big problem. That's something that hasn't happened in the modern Steve Jobs nor Tim Cook eras. The fact that this new product category they're launching is not going to have any mainstream pickup for several years or generate any material revenue, that's a problem. The fact that Massimo proved that you could beat Apple in a patent infringement lawsuit and get their product off the market, that's a really big deal. So there's a lot of negative noise around Apple. I still think that the fundamentals, the moat they've created, the ecosystem, the iPhone, people holding on to their devices, buying new services, I think that's all pretty strong, but it just feels a little weaker than it ever has.
Anurag, I see you nodding here from Chicago. Tell us your thoughts based on what you heard from Mark.
Yeah, absolutely agree with Mark. In fact, but the only thing I would say is all of this, iPhone weakness came out when they reported results on November the 2nd. That's when we knew when they missed China numbers by a big amount. We had heard about, competition from Huawei. All of those things are important because we were hoping that by this year we should see a improvement in China smartphone sales. Only because the year before we had COVID-related problems and there was a depression in sales. I think that really is something that, when they came and gave guidance, to be honest, I was surprised that the stock didn't react the way it's reacting now at that time. So I think it could be a year-end, portfolio management or whatever it was. But I agree, this year is going to be tough for them. They're going to grow somewhere between 3 to 5% revenue. Then you buy, a little bit of buybacks in between. So this is the new normal for Apple. It has been for the last 2 years.
Well, Anurag, let me follow. The new normal, does that mean Apple at some point needs to think about China not being as big a market as it has planned for it to be?
Well, China is a big market for them. There is no way out of it. But see, the way you want to think about Apple in totality, and I'm only going to focus on iPhones right now because that's really what drives the product growth, at least in the near term. When you look at the global market, they have a very high market share in the U.S., which is a mature market. Then the next big market is China, where they have less than 18% of unit market share. But as people become more rich, they go out with and get a more premium brand. Then the next big market is going to be India, where they have less than 5% market share in terms of the units. So the way you want to think about Apple is over the next 3 to 5 years, the big unit shipment numbers are going to come from China, and after that, India. In the U.S., we have phones, we're going to refresh it, 3 years, 3.5 years, 4 years, and that's a bit of a saturated market. So China is the growth engine when it comes to phones, and that's where we are seeing some, I would say, slowdown.
Hey, Mark, for years, we've been hearing about how the iPhone just powers Apple. And indeed, it does account for more than 50% of the company's revenue. But we've also heard the risks associated with that. What is the most compelling new product category for Apple that will help offset some of this slowing iPhone growth?
You know, it's an interesting question. People for years, like you said, have been talking about, is it a risk that everything revolves around the iPhone and half the revenue comes from the iPhone? I think it's even worse than that, because you're buying AirPods if you have an iPhone. You're buying an Apple Watch if you have an iPhone. All these services that Apple are selling, Fitness Plus, TV Plus, Apple Music, the App Store, every time you download an app, where are those downloads happening? It's happening on the iPhone. How many people own an iPad or a Mac and don't own an iPhone? How many people buy an iPhone before they buy an iPad or a Mac? So if you really think about the ecosystem in totality, it is 100% built around the iPhone. You know, this new Vision Pro, to answer your question about new product categories to drive revenue, that's not going to drive revenue anytime soon. If they sell out of all their inventory for 24, you're talking about $3 to $4 billion in just revenue alone, probably about $1 billion in profit, maybe a little bit less. That's nothing, right? I mean, Anurag can get into how minuscule that is. And so I think long-term, mixed reality, augmented reality, virtual reality, those are fine categories for Apple. But I think right now it's nothing more than a pipe dream in terms of that becoming a revenue generator.
Anurag, come on in. You are nodding your head. Go ahead.
Yeah, I mean, it's as I said, that's why, you know, I would say 75% of my focus goes into the iPhone and the work that's, you know, we do around it. And, you know, at this point, we should have seen an improvement in China. China, you know, there were about 100 plus million phones that need to be refreshed. We haven't seen that number move quite a bit. I mean, in terms of the base is a little bit more than that. But, you know, China is going through weakness. You know, we have a brand new model from Huawei, but they haven't released in a while, so people are refreshing that. So, I mean, it is a bit of an issue, but frankly speaking, we really think Apple is a unique brand. Apple is a marquee brand. If you look at globally, the smartphone market, Apple has less than 20% of market share by units. I'm not talking about revenue, by units. Think of Apple very much like an LVMH, like what Coca-Cola was in the 50s and 60s, whereas countries that don't have the purchasing power to buy those products right now, as they become more richer, as they become more affluent, they're going to go with a marquee brand, and that's Apple. But if somebody's thinking they're going to grow 10, 15%, I mean, they need to recalibrate their thinking. This is at most now a company that's going to grow in a weak economy around 3 to 5%, in a good economy between 6 to 8%, which, to be honest, it's not bad. This is a brand that can, you know, conquer a lot in the long run.
Right.
But in the near term, we do have growth problems.
Mark, I think that's such a great point. Just got about 20 seconds here. This reset in terms of they still sell a ton of stuff, guys, but it's not going to be as aggressively growing. We need to think about that just quickly.
It's been the case for years now. You know, in terms of revenue, Apple's very much like the new IBM. In terms of products, they want to prove otherwise, and this is the year to do it.
Listen, guys, thank you so much. We were looking to do a smart roundtable fundamentally about the Apple story, and you guys just laid it out for us so well. Happy New Year. Mark Gurman, Chief Technology Correspondent here at Bloomberg News out there on the West Coast, and our Anurag Rana, a must-read, as I always say, when it comes to a lot of things going on in the technology world, including Apple. He's Senior Tech Analyst at Bloomberg Intelligence out there in our Chicago bureau. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. Just getting December Costco sales numbers. It reported total comparable sales for December of a gain of 8.5%. Costco, by the way, today had its price target raised to $614 from $547 at Barclays. Costco today up by 0.6%. After the sales numbers after ours, Costco shares up now by just about 1%. Turned out to be a down day for the U.S. stock market. Another down day for the S&P 500 index. Treasury yields rose. Tech stocks dipped ahead of tomorrow morning's jobs report. S&P down 16, dropped today of 0.3%. Dow Industrials held on to a 10-point gain. Little change there. And NASDAQ was down 81, a decline of 0.6%. 10-year 3.99%, 2-year 4.38%. Spot gold up today by $2 the ounce to $2,043, up by about 0.1%. And West Texas Intermediate crude fell 0.4%, 72.38 a barrel. Bitcoin today up 3.4%, back above 44,393 on Bitcoin. Apple got its second downgrade this week, this time from Piper Sandler. Piper Sandler cites a weak macro environment in China that will dampen demand for iPhones. Apple shares lower today by 1.2%. Again, recapping, stocks end of the day mixed. S&P down 16, dropped there of 0.3%. The Dow higher by 10 points, a little changed. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, a down day for Apple, but not so for Peloton. Investors jumping on their Peloton positions, sending the stock rallying. Like what I did there?
I like what you did there. You're a Peloton. Are you still paying them?
Yes.
do you ride a
Aggie
Peloton?
jumped on the bike.
Okay.
She's home.
Okay. Well, they like people like you. Pay every month and don't use the product.
All right. New Year's resolution. Anyway, the stock did rally about almost 14%, off its highs, but nonetheless up 14% in today's session on news and hopes that it will become a TikTok star. Peloton Interactive launched a partnership with TikTok today. They're going to create a fitness hub on the popular video app, tap into a new pool of potential customers, right? They're hoping, Tim.
Fingers crossed, at least for Peloton, right? The stock was a pandemic darling. We don't need to tell you this. No. Everyone was talking about it. We were all stuck at home. We were working out at home. Carol, you made this point earlier,
but
it's still off 95% from its all-time high back in January of 2021.
It's a $6 stock. I'm just going to put that out there. All right, so let's get to it. On the news, the fundamental story behind this once-beloved stock, Bloomberg Intelligence Technology and Media Analyst Geeta Ranganathan is with us on Zoom from our Bloomberg Intelligence headquarters in Princeton, New Jersey. Happy New Year. How are you?
Very good. Thank you. Happy New Year to both of you as well.
It's so nice to have you here. Let's talk about Peloton. Is this news, in your view, a game changer for Peloton? Is it interesting? How are you looking at it?
It's definitely interesting. It's a mild positive, I would say, but in no way is it monumental or is it a game changer. So I think what Peloton has really been trying to do is change its focus. We know it was originally basically this upscale premium kind of fitness hardware or bike product, but they've really kind of been trying to change that perception to become more of a fitness content company and a fitness content provider that is accessible to all. And I think, this TikTok deal obviously does that. It really kind of broadens their reach, their appeal, their user base. TikTok has 1 billion users. They're obviously going to appeal to many more users and many more younger users. And I think that definitely will help them. The ultimate question, of course, for Peloton, Carol, is are they able to convert all of these different users, most of them free users, to paying users, and that's where they've really struggled.
That was my question for you, because if you look at TikTok's demographic, it's not necessarily, correct me if I'm wrong, but it's not necessarily a demographic that's going to want to shell out. When you're a kid, you're not going to pay a monthly fee for a workout app. You're like, going and playing soccer after school.
Well, I think it's a really good point.
You're not. They're not 40. Like these kids, you know what I mean?
But he makes a point, right, Geeta?
No, absolutely. He's absolutely right. And Peloton has recognized this, right? So they have this new CEO, Barry McCarthy, who's kind of had this turnaround plan and action. So they've done different things to make the product so much more accessible. They've introduced, so that their whole concept is, Peloton is now fitness as a service. And so to that end, they have a bike rental program. They have all of these refurbished kind of products that they're offering. They've revamped the app, and they're offering different tiers. So it's not just the $45 per month, full service. They're offering a much more kind of skinny version, one at $12.99 a month, one at $24.99 a month. So they are trying to do their best. The problem is it's just, it isn't enough.
Yeah, there's also, they've got deals with Lululemon and sports organizations. It feels like they're throwing up a lot against the wall here, Geeta. What is, I think about, when we think about the balance sheet of a company, we think about assets, we think about liabilities, we think about their costs. What do we see? When you look at the Peloton balance sheet, what do you see?
Yeah, it's definitely not pretty, Carol. So you have about $2.3 billion in total debt. Of course, they have some cash, about $800 million or so, but you still have over $1.3 billion in net debt. The problem really for this company is, one thing is, obviously connected fitness demand itself is really slumping right now. We're not having, we used to have connected fitness subscribers, which is their primary metric, which was about 4 million. We've actually seen a lot of those people churn out as kind of economies have reopened. They've also had, a lot of things that have worked against them, including bike recalls, which is again kind of led to, people kind of canceling their subscriptions. So that's a problem. Again, they're trying to get, people with this free app. It's not really necessarily resulting in people converting to the paid app. And so that's another huge problem. So when you kind of look at it from a long-term perspective, the free cash flow seems to be a real problem for this company. There's really no line of sight. We had them burning about $2.5 billion of free cash flow in 2022. That came down pretty significantly last year to about 500 million, but they're still not going to be free cash flow positive for a long time. So, this is a company that's kind of really struggling. They're trying to do their best, but I don't necessarily see them having, sustainable earnings growth or sustainable free cash flow growth going out into the future.
Geeta, are there still questions about Peloton continuing as an independent company?
I mean, there have been so many rumors out there, Tim, whether it's Amazon kind of coming in, whether, Apple would want to do something with its whole fitness lineup. I don't necessarily, or even Nike for that matter, I just don't necessarily see any company kind of wanting to, necessarily buy this product right now. But long term, I think eventually it does become an M&A play.
An M&A play, really fascinating. And
it seems like a perfect private equity play.
It does seem like, well, that's what I was wondering, Geeta, would they be smarter to build up? It's expensive, but like kind of their retail outlets where you have to go somewhere. Because I do feel like we're living in a world where people don't want to, now they want to get out of their homes, right? They've done it. We're out of the pandemic. Would that be a smarter play? I mean, that's a more costly when you've got all that overhead. But I'm just thinking that idea of community and going somewhere for a class.
No, absolutely. That makes total sense. Again, but their whole, and you mentioned the cost aspect of it, Carol.
Yeah.
Their whole focus right now is cutting costs, and they've done a pretty good job of it. But I think eventually, as they kind of look out for new growth prospects, they're obviously trying out new modalities. They have the new Tread Plus that's out there in the market, of course, at a very pricey point of over $6,000. But again, we have to wait and watch and see what exactly the management team comes up with over there.
Hey, if we can switch gears, speaking of management teams, Bob Iger, long lauded as an incredible manager in terms of the things he did at Disney.
I thought you were going to say like he, has a Peloton. I don't know.
I don't know.
I don't know what you're going to do with the transition.
I'll call him up and check it out. But long lauded, but he came back to the company after retiring. He's facing some challenges, including some activist investors. He seems to be kind of, gaining their support to some extent. But how are you thinking about Disney and what's likely to happen to that company this year?
Yeah, I mean, obviously, as you kind of pointed out, Carol, the sentiment has obviously soured a lot on that stock.
Mm-hmm.
I don't think they're necessarily out of the woods completely, but I think we did kind of see some green shoots, at least in their last earnings report. So one of the big things, and for me, the key takeaway from that last earnings call was, they upped their cost savings, which is up from, $5.5 billion to $7.5 billion. But more importantly was their guidance for free cash flow. So they're guiding in 2024, they're guiding to $8 billion in free cash flow, a massive upside from what it was in 2023. And more importantly, it's back to pre-pandemic levels. So they are laser focused when it comes to streamlining the business, when it comes to kind of cutting costs, when it comes to kind of reinvigorating the whole content pipeline. So Bob Iger absolutely knows what he needs to do, how he needs to right the ship. It's going to take a little while, though, for everything to kind of fall in place. But I absolutely think Disney is one of the best plays in media, just kind of given their collection of assets, just kind of given their scale.
Geeta, 30 seconds. Any predictions on potential shedding of assets this year from Disney?
Yeah, I mean, the linear TV assets keep coming up every once in a while. We know that there's something happening with their Indian assets. They're kind of merging that with Reliance. So that's the big thing that's happening right now. Not shedding, they're going to gain 100% control of Hulu. We don't know exactly what the price point is, but that's going to happen. And then, I think the one thing that could potentially be a catalyst is outlining some kind of strategy with ESPN.
Interesting. Steamboat Willie, that was already shed. It's now out in the public domain. Do you know about Steamboat?
I do. I didn't know that was in the public domain, though.
It is now. Yeah, it entered at the start of the year. Geeta.
Wow.
Thank you. Covering Peloton, covering Disney, and so much more. We so appreciate it. Geeta Ranganathan of our Bloomberg Intelligence team joining us here on Bloomberg.
Hey, let's go to Washington, D.C. now for a check on the latest world and national news. We got Nancy Lyons in the Bloomberg 991 newsroom. Hey, Nance.
Thanks, Tim. We are receiving new information regarding the school shooting this morning at a small-town Iowa high school. Mitch Mortvedt is the assistant director with the Iowa Division of Criminal Investigation.
The shooter has been identified as 17-year-old Dylan Butler, a student at Perry High School. Butler was armed with a pump-action shotgun and a small-caliber handgun. Butler also made a number of social media posts in and around the time of the shooting.
Mortvedt says the suspect died of what investigators believe was a self-inflicted gunshot wound. A sixth grader was killed. 5 other people were wounded in the attack. At least one of the victims is a school administrator. Perry, Iowa has about 8,000 residents and is 40 miles northwest of Des Moines. New York City Mayor Eric Adams is filing a lawsuit against 17 charter bus and transportation companies that have transported migrants to the city over the past 20 months. The lawsuit is seeking the payment of costs associated with caring for the nearly 34,000 arrivals, estimated to be at least $708 million. An employee of one of the bus companies says they don't make policies, they're just a transportation company. U.S. officials say Russia is receiving weapons support from North Korea, possibly even Iran, as it continues its war on Ukraine. National Security Council spokesman John Kirby is confirming ballistic missiles are included in the package.
These North Korean ballistic missiles are capable of ranges of approximately 900 kilometers. That's about 550 miles. This is a significant and concerning escalation in the DPRK's support for Russia.
Kirby says the U.S. will impose additional sanctions against those working to facilitate any arms transfers between Russia and North Korea and Russia and Iran. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. Next stop for Wall Street, the jobs report tomorrow morning. The Dow higher today, S&P, NASDAQ 100 index, and yes, Russell 2000 all declined today. Treasury yields rose, stocks dipped as traders look to tomorrow's jobs report for clues on how soon and how deeply the Federal Reserve can start cutting rates. S&P today lower by 16, dropped there of 0.3%. The Dow today up 10, little changed, up less than 0.1%. NASDAQ, the composite index, down 81, a decline of 0.6%. NASDAQ 100 index lower by 86 points, a drop there of 0.5%. For NASDAQ 100, that represents a 5-day losing streak. 10-year yield 4.00% right now, with a 2-year that's yielding 4.38%. Spot gold today up by $1.83 the ounce to $2,043, up 0.1%. And West Texas Intermediate crude down 0.4%, $72.41 a barrel. Ryan Dietrich is chief market strategist at the Carson Group, and right here on Bloomberg Business Week, he told us he sees the foundation for further stock market gains.
When you have a good end-of-year rally like we just did, up 14% for the S&P the last 2 months of the year, when you gained at least 10% those last 2 months, only happened 6 times. The full next year has been higher 6 times, up 20% on average. So I call that like a slingshot, right? I mean, when you have a lot of strength to end a year, history would say, listen, price side with that following year still being pretty strong.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Wells Fargo and JP Morgan Chase have been named top picks for Goldman Sachs analyst Richard Ramsden in a 2024 note. Today, Wells Fargo was up 1.2%, JP Morgan up by 0.7%. They do report earnings a week from tomorrow. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, so appreciate it. You are listening and watching Bloomberg Business Week on this Thursday. Carol Massar along with Tim Stanovic live in our Bloomberg Interactive Broker studio. We're streaming on YouTube. We are also streaming on Bloomberg Originals.
One of the biggest news stories of the last year was the demise of San Francisco.
Right, like it was over, right? Everybody's leaving. It's falling apart. Businesses don't want to be there.
Real estate is collapsing.
Yeah.
The problem of the unhoused is huge. There are drug addicts everywhere. It was a doom loop. It became critics' shorthand for problems wrought by remote work and drug addiction, a cycle that drove people out of the tech capital of the world in huge numbers.
But here's something, folks. Reality really hasn't caught up with this list of woes. In the 12 months ending July 2023, the city actually gained 4,900 residents after also seeing some slight growth in the prior year. This is according to some new data. So, you know, our team here at Bloomberg News, we kind of wanted to know, like, what's going on here?
Well, look at the numbers. Priya Anand certainly did, technology and venture capital reporter. She took a look at the greatly exaggerated demise of San Francisco. She writes about it for today's Bloomberg Tech Daily newsletter, which you can sign up for at bloomberg.com/technology. Priya joins us from our San Francisco bureau. Priya, it has been about a year since I've been in San Francisco. Carol and I had a pretty good trip there.
We did.
In December of 22.
Right.
Yeah.
It's been a while.
Yeah, we had a good trip there.
And I know people were like, be careful walking the street. I'm like, I walk around in New York. I'm like, am I going to be okay? You're going to be okay.
Yeah, you're going to be fine. It is a beautiful city, one that's very certainly, as a Californian, very close to my heart. What prompted you to write this story? Because it was a personal experience.
You know, I was walking the Crosstown Trail in San Francisco. It's a 17-mile trail path that goes through different neighborhoods in the city, takes you to lesser-known places, more-known neighborhoods, ends with a gorgeous view of the Pacific Ocean. On New Year's Day with some friends is sort of an annual tradition to be out and about in the city on a beautiful sunny day. And the whole time I was just thinking, you know, there's so much conversation around San Francisco being in decline. And of course, I'm not saying because I had an enjoyable walk through the city one day, there aren't challenges in this city, right? I think anybody who comes here, lives here, experiences life in San Francisco is going to agree that homelessness is a huge crisis for this city. The drug
but it
crisis
has been for
is
years.
a big problem.
I feel like homelessness has been a problem for years there.
That's right. These have been long-standing problems that San Francisco really must grapple with and deal with and find a way to solve. But at the same time, there's been all this conversation around how the city's over, it's in decline, but the data is not bearing that out, right? I mean, I received this is a very polarizing topic, though, and clearly folks around the country who do not live here do live here. People have a lot of opinions on this. So I wrote this story about how the numbers show that the city actually hasn't lost much of its population over the last few years, which is in contrast to a lot of the conversation around how this place is decaying. But I received some pretty charged reader feedback, actually, more than usual. One reader compared San Francisco to Afghanistan and Detroit. I was surprised to see Afghanistan in that email, though, pop up as a point of comparison. So people clearly have a lot of feelings about this place, but I'm not quite sure how much those people have actually spent time in San Francisco. And once again, there are plenty of challenges for the city.
Or Afghanistan.
That's probably also
Well
true,
said.
right? The city's chief economist, though, isn't saying that these problems don't exist. And he told me, look, there is a risk that San Francisco could enter a doom loop at some point if the city responds in certain ways to its challenges, if the city were to alienate its tax base to the extent that people would leave and then create more of a drain on its finances. But the data has not proven that that doom loop is actually here now. There are risks, and the city has to manage this time kind of carefully while people are still looking at remote work and the ability to not necessarily have this be their center of gravity in the tech industry especially. But this is still a place where people in the tech industry are coming in multiple days a week, lots of companies.
And as you point out, Priya, it's also a place where venture capitalists continue to deploy money to companies that are based in Silicon Valley. So talk to us about the data that you found there.
That's right. So while there have been all these other cities that have been gaining more venture capital dollars over the years, you know, more and more startups have cropped up in New York. There was a lot of hype around Miami and the startup scene for a little while. Hype more so than I think that actually bearing out in the numbers. The Bay Area, by far, still gets the most venture capital dollars. And at the end of the day, AI companies now are cropping up and opening offices in the Bay Area. They are mandating that their workers come in 3+ days a week. OpenAI famously has folks in the office almost every day. They're based in San Francisco. I wrote a story last year, I guess I can't say earlier this year now, we're in 2024. I wrote a story in the fall about how AI offices are snapping up, AI companies are snapping up more office space in San Francisco. Not necessarily downtown, in other parts of the city. So downtown still has its challenges here for sure. But AI companies are opening up offices here. They're trying to get their staffs to actually move from other parts of the country and the world to San Francisco because they believe there is a gold rush right now in that sub-industry within tech and that they need to capitalize it, and that having people together in person, solving problems in this burgeoning field is the way to do it. So there is a lot more fervor around being in San Francisco in person than there was early last year, and AI is a huge part of that.
I love your emotion behind this because it's really great to hear. Because you're right, the story, the narrative has been one of a doomsday, no doubt about it. What about tourism? What are we seeing? I mean, I think it's a beautiful city. Every time I go, it makes me so happy because it's just gorgeous, and it
doesn't hurt that the Bloomberg office is literally on
the water.
Like if you see Priya's shot, like that's what you see from the Bloomberg office.
It's pretty incredible. But just got about 45 seconds left here. I mean, tourism, you're seeing them out and about?
There's been some rebound in that, and if you go out into restaurants in the city these days, like you got to have a reservation to go anywhere great over the weekend now again. Unlike the early stages of post-pandemic life where everything felt like you could go anywhere. But look, I'm not. This story is rooted in the data. It's rooted in my reporting on this industry, which I have been covering for about a decade now. And I'm not. I want to be clear that this whole storyline is not about woman went on a beautiful walk in San Francisco, thinks the city is great now, right? I'm not blind. This is based on the data. It's based on the facts.
Great story, and really something that I think it's good to get this perspective out there, considering the backdrop. And I love your perspective on it, because I get it. I get where you're coming from. Priya Anand, thank you so much. Happy New Year. She's technology and venture capital reporter at Bloomberg News in our San Francisco bureau. And, I brought out the homeless, not to say that, to remind them that there's, it's been around for a long time, but I feel like people kept bringing it up, like, look at the problem. And maybe it got worse coming off of the pandemic, but it's been something they've been trying to grapple with for some time.
And San Francisco is by no means the only city that's dealing with this right now.
No.
We here in New York are certainly dealing with it as well.
Anywhere it's warm or there's, better...
It's not even warm here.
Yeah, that's true. It's not exact. Anyway, really fun to check in with her, Priya Anand. You are listening and watching Bloomberg Business Week. This is Bloomberg Radio.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. McDonald's says it is experiencing a, quote, meaningful business impact in the Middle East because of the war between Israel and Hamas. This according to CEO Chris Kempczynski. The burger chain became the target of boycotts after photos and videos on social media showed franchise stores in Israel giving meals to the nation's soldiers following the October 7th Hamas attack. McDonald's operators in countries including Saudi Arabia, Malaysia, and Pakistan said the actions did not reflect their own views. McDonald's today down by 0.9%. ConAgra Brands has cut its fiscal year guidance on expectations that cash-strapped shoppers will continue to buy less packaged food in coming months. And with more on that story, here's Bloomberg's Lisa Mateo.
Charlie, the Chicago-based company now expects organic sales to be down 1% to 2% for the year ending around late May, compared with a prior forecast for 1% growth. Conagra's brands include Slim Jim Meat Snacks, Duncan Hines Cake Mix, and Hunt's Tomato Sauce. Profit excluding some items is now projected to be as low as $2.60 a share, down from a low of $2.70 previously. Consumers, including high earners, grew more cautious about spending during the final months of 2023, cutting back in various areas, including dining. Charlie.
And that's Lisa Mateo. Today, Conagra down 1.9%. Walgreens Boots Alliance down 5.1% after its new CEO slashed the troubled drugstore chain's dividend. And those are some of our top company stories at this hour. I'm Charlie Pelleton. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenivek and Carol Messer live from the Bloomberg Interactive Brokers studio in New York. Let's go to Washington, D.C. for a check on the latest world and national news with Nancy Lyons in the 99.1 newsroom. Hey, Nance.
Thanks, Tim. Perry, Iowa is the latest community to deal with a school shooting. Multiple people were shot this morning before school had started. This according to Mitch Mortvedt with the Iowa Division of Criminal Investigation.
There are 6 victims, one of them who is deceased. That individual was a 6th grade student at Perry Middle School. The other 5 are being treated at area hospitals. 4 of the surviving victims are students, and the 5th is a school administrator.
Mortvedt says the suspect was also a student at Perry High School and is believed to have shot himself. He also left behind an improvised explosive device. New York City Mayor Eric Adams is going after Texas charter bus companies that have been transporting migrants to the city. In a lawsuit, he's seeking $708 million from 17 charter companies to cover the costs of caring for the more than 30,000 migrants that have been transported. He's also calling out the Texas governor for busing them in the first place.
These companies have violated state law by not paying the cost of caring for these migrants. And that's why we're suing to recoup approximately $700 million already spent to care for migrants bused here in the last 2 years by the state of Texas.
Adams says the busing is a violation of a New York social services law that requires companies to cover the costs if they intentionally transport people in need of shelter or services as part of a bad faith plan. At least 8 people are nursing minor injuries after 2 New York subway trains collided and caused a derailment in Manhattan's Upper West Side. The New York Times reports a northbound train collided with a work train that was switching tracks. Actress Glynis Johns has died at the age of 100. Stephen Sondheim wrote Send in the Clown specifically for her husky voice.
Isn't it rich? Are we a pair?
John's manager says she died of natural causes. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg. Now back to you, Carol and Tim.
All right, Nance, so appreciate it. Hey, this story coming among the most read on the Bloomberg terminal. Bill Ackman's wife plagiarized multiple paragraphs of her 2010 doctoral dissertation at the Massachusetts Institute of Technology. This is according to a report in Business Insider, but Bloomberg also then reporting on this report.
Yeah, we're talking about Neri Oxman. At least one of the passages was lifted directly from another writer without citation, according to an analysis by Business Insider that was posted this afternoon. Ackman, of course, is the billionaire hedge fund manager. And the reason we're talking about this is because he cited allegations of plagiarism against Harvard president Claudine Gay among the reasons he spent weeks calling for her removal. Gay was the school's first black leader, resigned on Tuesday following the allegations, as well as criticism of her handling of anti-Semitism on campus in the aftermath of Hamas's October 7th attack on Israel.
And you were just talking about Bill Ackman's response on Twitter X. He's got more than 1 million followers on that platform. He responded on the platform saying that, quote, "You know you struck a chord when they go after your wife." He says, "I'm one of the most fortunate people in the universe, in large part because of her." And he goes into it a little bit more.
He retweeted a post that she did that is incredibly long, that actually goes into detail about the allegations. She acknowledged the Business Insider claim that she paraphrased Klaus Matek without citation, writing, quote, "I deeply apologize to Matek for inadvertently not citing him when I paraphrased the above sentence," she wrote. She also said that while she properly credited the original source's authors in the 4 paragraphs referenced by Business Insider, she didn't place the subject language in quotation marks.
You know, academia, this is, you know, they want all of the, you know, you want to be very careful that you're giving credit to everyone. I just feel like we can do, you know, an hour on, okay, let's talk about, you know, making sure that citations are correct. I told you about my daughter, like when she writes a paper now, there's actually a platform or some program that their papers go through to say, wait, this looks like 8% of things that are out there or research. So I don't know. Interesting times. You're listening and watching Bloomberg Radio.
This is